Sunderland, and I'm the Chief Investment Officer of Beacon Law Consultants. And this is your July 2019 market update. Well, July was a mixed month for equities. While domestic small cap and large cap stocks had small gains, as shown there by the yellow and red bars, international stocks, as measured by the MSCI ACWI ex-US Index, the gray bar there, as well as the Bloomberg Commodities Index, the green bar on the end, they both fell this month on a strengthening dollar. But year to date, performance across the major asset classes has been quite robust. Domestic large cap stocks, the yellow bar, as measured by the S&P 500 index, is up over 20%. Small cap stocks, the red bar there, that index is up 17.66%. International equities year to date, up 12.22%. Commodities are up over 4%, and even the Barclays Aggregate Bond Index, which is a measure of the return of domestic investment-grade securities, is up over 6% year to date. And usually if equities are rallying, especially to this extent, bonds don't perform as well and vice versa, but we aren't seeing that occur this year because much of the rally for both stocks and bonds has been due to the market's interest rate outlook. And I wanted to spend some time on that subject today, as it was one of the most closely watched market events during July. So before we get into the specifics of what actually took place in July in regards to interest rates, let's take a step back to review why the Central Bank of the U.S., the Federal Reserve, adjusts interest rates in the first place. So the federal funds rate is the rate that the Fed adjusts, and it is one of the tools the Fed has to help meet its dual objective of maximum sustainable employment and stable prices. And to the Fed, stable prices means inflation near 2%, which is a rate of inflation that's not too hot for the economy and not too cold. And this short-term interest rate, the Fed funds rate, serves as a benchmark for rates on borrowing and yields earned on savings for businesses and everyday Americans. It directly affects short-term interest rates and indirectly affects long-term ones, currency exchange rates, and stock prices. So you may be wondering, well, why does the Fed cut interest rates in the first place? What would lead the Fed to do something like that? Well, the Fed lowers the Fed funds rate in order to stimulate the economy by making it cheaper to borrow money. So when they lower the Fed funds rate, you can just follow along here on the chart, rates and lower interest rates occur then on credit cards and home equity lines of credit. And then rates on loans such as mortgages also gradually follow the direction of the Fed funds rate lower. So when interest rates are lower, people are more likely to spend money than to save it. And it's important to remember that consumer spending in the United States accounts for about 2/3 of gross domestic product. So by lowering interest rates, the Fed can induce people to spend more money and thereby lengthening the economic expansion. And similarly, in a low rate environment, companies can also borrow money more cheaply and use those funds to grow their businesses. So it is a way for the Federal Reserve to help boost economic growth. Now, they can also do the opposite, and this is what the Fed has been doing for several years. The Fed can also raise interest rates. When the Fed increases the federal funds rate, it effectively is doing the opposite of what's shown in the chart here, and it's really used to slow an overheating economy or to reduce inflationary pressures. So what happened in the month of July is that on the very last day of July, July 31st, after an extended tightening cycle, which means tightening means the Fed was raising interest rates. After raising interest rates for many years, the Federal Reserve lowered interest rates for the first time since December of 2008. And in doing so, they created utter confusion for economists and traders alike. So while a small cut to interest rates was expected by the markets, market participants were not excited about the language of Fed Chairman Jerome Powell at the press conference following the announcement. He made some very confusing statements regarding the reasons for the rate cuts and whether or not more rate cuts were coming. So initially, he stated that this was just a mid-cycle adjustment and hinted that further interest rate cuts were not a sure thing. That caused the market to drop pretty much as soon as he said that during the press conference. But then later on in the conference, he backpedaled on those comments, which caused the market to pair some of its losses on the last day of July there. So the issue here is that the Federal Reserve's communication and transparency has been subpar relative to that of past Federal Reserve boards. And this has been concerning because this is now the third or fourth time in the last 6 months that the Fed has made announcements and then backpedaled on it a short time later. This causes a lot of uncertainty for the markets, and the market does not like uncertainty. It's difficult to forecast what could happen to stocks and bonds and companies and earnings and the dollar whenever the central bank is waffling a bit on their comments. So I would expect a bit of shorter term volatility until the market is able to adjust the latest positioning from the Fed. So taking a step back now, what is our view of the economy overall? On the right here, this is a chart of US gross domestic product. You can see the latest reading there was just above 2%. And what this shows is while GDP data released in July showed really both a moderation in the pace of economic growth and low year-over-year inflation, consumer spending was still very strong, which is important because, again, that accounts for about 2/3 of GDP in the United States. And while job growth is gradually slowing, the pace remains healthy for this stage of the expansion. And overall, we really see few signs of genuine recession risks over the next 6 to 12 months. And so while the Fed did cut interest rates, it was seen more of an insurance cut in that it's just a way to help prop up the economy as we're starting to get some slower growth data both here and abroad, but certainly not, the economy certainly not in a state where it is alarming to us or to the Federal Reserve. And we will continue to monitor the market and we'll make changes to the LightPoint portfolios as warranted. We thank you for your continued confidence, and please reach out to us with any questions you may have.